Hello again. In this video, I will be talking to you about designing a risk management system. Risk management is the most important thing when it comes to trading. A lot of people don't realize this going in, and that makes a lot of sense because you're wanting to know when to get in, when to get out, that type of thing. The reality is that sooner or later, given enough luck, you will make profitable trades. The market's either going to go up or down. So, in theory, you have a 50% chance of being right or wrong at one point or another. So, with that being the case, risk management is where everything really gets decided as to your long term profitability. There are a couple different ways to look at it, and there's the mathematical way, and there's a billion articles and videos and books about that out there. Typically traders will risk 1%, maybe 2% of their account at the most, and they'll place a trade so that if you lose a trade and you lose 1% of the count, you're not doing a lot of damage yourself. You can have multiple losses in a row, and that's fine. But the real way to decide what your risk management system is will be what you can actually use. In other words, what I mean is what you're comfortable with. Some traders will find that they are perfectly comfortable trading 1% risk, risking 1% of their total account on a particular trade. Other traders will find that they can do 3% or even 10%. Now, the odds of somebody risking 10% every time they trade and coming out ahead in the Forex world are very slim. The reality is that you should not be leveraging up that kind of uh, aggressiveness. Now, having said that, if you're comfortable doing it, then you at least have the ability to work with whatever trading system you have. One of the easiest ways to figure this out is to place trades at perhaps a 0.5% increments. So what I mean is the first trade, you risk 0.5% of your account. Notice how you're feeling. Notice if you're messing with the trade, if you're jumping in and jumping out, if you're fidgeting. And if that's not an issue, then you go up to 1% and notice how you trade again. Is it something that you can place the trade and walk away from the computer perfectly comfortable with your stop losses and everything else? And then so on and so on. What you'll find is there will be a point where your nerves will take over. And that is clearly too much leverage. That's too much risk. A lot of risk management books don't go into that. They go into the mathematics. Now, mathematically speaking, most large firms only risk minuscule amounts, maybe like 0.2% on a trade. I realize you're a retail trader, you're trying to make a few more bucks than that, so it makes sense that you would risk 1 or 2%. And it's really going to come down to your personality. So, with that being said, the first thing you need to do is realize what you're comfortable with and what you can handle. That is the biggest hurdle. Once you get past that and you have a set percentage, then it's pretty simple. You just take, say 1% of your account and risk that, and wherever you need to place the stop loss, you figure out how much per pip you should be trading and leave it at that. Some people don't use percentage and they use a specific amount of pips. They'll say something like 100 pips on the stop loss. And the problem with that is the market doesn't care that it's 100 pips below. What you really want to look for is support and resistance, places that they've made a trade, a massive turnaround or whatever, where the market does care. So I'm not a big fan of fixed numbers. Percentages are one thing because you can tailor those to the position size, but an actual fixed number is a completely different story. So really at this point in time, it's the psychology that I would press upon you more, because there is no right answer with a risk management system. It's just what's comfortable for you. And at that point in time, what you can use consistently and without concern.